Okay. Can everybody see my screen?
Yes,
All right,
sir.
here we go. And I'll try to keep an eye on the chat box, but how's everybody doing on this Friday? It's a beautiful Friday before Mother's Day weekend, so everybody's good. So again, here we are, 2021. What is going on with this market? So going to go through some of the same numbers we've been through in the past, but wanted to share everybody. So here we are, median sales price. Remember, this is all of Charleston, so I'm not sorting anything out. This is all of our entire MLS. Median price is up 18.4% year over year. Now, if we go back and we look at, and this is April, right? So we were at 290, we're at 343. So, I mean, we are $53,500 higher than a year ago on median price, which is, quite phenomenal. So what we have to keep in mind is, remember last April and May, look at these numbers here. Last April, May, June, were all pretty flat. We were in shutdown mode for most of March and April, so those contracts reflected in March, April, May, and even part of June. So look at this jump once we get to July, August. So we're the next 2 to 3 months, we're going to see the biggest numbers here, in my opinion. These are going to be the peak numbers that we're going to experience between April, May, and June. So 18.4%. Now, what's amazing is, watch this. So this is median price. So remember, median means 50% of the houses in Charleston are selling under this price and 50% over this price. But watch when we flip to average. The average is 32% higher. So this is showing to me we have some big number of houses selling, 5, 6, 7, 8, 10 million, which is driving up that average. So 32% in a year. So I mean, if we go back to April, here's April, 375, we're almost at 500,000. So that's almost $125,000 higher on average price in a year, which is phenomenal. So, look at what happened. April to May was actually lower last year. So I would venture to say next month, this is even going to be a higher number on the average. But then we started to jump coming out, into June, July, August. But I mean, traditionally, I like to talk about median price. It's a little bit better reflection. The average kind of, if you have some high sales in there, it will skew it one way or another. Or some really low sales, it'll skew it the other way. So 343 is the median price. Now, if we go back in time, I mean, that's pretty steady growth from 2011, right? With this kind of being, a fairly quick ascent over the last couple of years, up to 343. So that goes back as far as 2004. Let's go back to 3 years so we can look at it a little bit closer. So price per square foot. So median price per square foot up 15.7%. But go to the average, it's the same reflection, 26.5%. So again, that's showing some very high-end properties selling, really kind of lifting that price per square foot number. And then percent of original list price. So we're stuck on this 100%. And I would love anybody on this call, if you can go to Market Monitor and put in a request, they need to get this fixed. This is, and I can't believe that they haven't fixed this yet, because I would imagine most markets across the country probably at 100% or higher. So it is stuck, and I don't know what it is. It could be 101, 102. I can go into MLS and try to figure it out, but they need to fix their program because they are stuck on 100%. So anybody in this call that wants them to put in a request to them or to our board to get them to fix this, I think this is a place we're going to live for a while. And we really need to understand, is it 101? Is it 103? Where are we at? Because that does, yes?
Yeah, I called, so I don't remember right now the name. It was a few weeks back. And of course, they're trying to get, it's ultimately Zillow, right? Is that right? Showing time is owned by Zillow. Anyway, it's the Market Monitor comes from Showing Time, of all things. And it would just be worth as many people as have the patience to do so, to call and complain. They're definitely aware of it. I don't know why it's not getting done now.
I mean, it seems like it would be a super simple fix, and I don't know what the problem is on their end, but,
Yeah.
and you know, just for reference point, so if I go back in time, they had this problem in 2005, 6, 7, or whatever is happening, they didn't fix that, you know. You can see we were obviously over 100% for a couple year period here.
So we'll
But,
end up
like, what
looking
did
like
that-
that. Yeah.
Yeah, what, and again, I think we're going to be here for a little while, and it's like it's kind of important to know. I want to see a turn in the market, and here I can't. You know, there's no way to see what's happening. So, you know, and again, median. So this is, we're looking at. Let me go to 3 years again. So we're looking at the median is basically stuck at 100, which, you know, it might be at 100.5, it might be at 101, but that basically means at least half the houses right now are selling for over full price. And I would venture it's probably closer to 60% are selling for over full price. If you look at the average, so the average, they've got it correct, but it's not at 100 yet, so it might flatline as well. But the median is going to tell us where we're at. But I mean, over half the listings are selling for over full price. And, you know, if you're selling over full price, and I'm not going to say this exclusively because I did have one closed earlier this week. I only had one offer and I got over full price on my listing. So I'm not going to say this exclusively, but pretty much if you are getting over full price, you're probably getting multiple offers, which tells me, you know, at least 60% of the homes are probably getting multiple offers at this point, if not higher. So if we flip to days on market, so we're down to 3 as the median. So the best way to explain that is half the houses are selling in under 3 days in Charleston right now, and half are taking longer than 3 days. So it's essentially saying the same thing what we've been saying on some of these other slides is that, you know, if we're getting 60% multiple offers, it's pretty much you're putting it on the market and you're sifting through offers the first couple of days, and then you put it under contract. So everything is pointing to that, and you can see where the trend is right now, and I can see it on my weekly analysis of our actives, is that everybody's kind of targeting that Thursday, Friday list, let the showings rip over the weekend, close them down Sunday night, review offers, and accept an offer either Sunday night or Monday morning. So that seems to be a fairly common trend that is developing. You know, there was no written rule that that's what's to do, but I think a lot of agents are kind of heading that way. And especially ones that they know there's going to be multiple offer situation. So, I mean, this kind of reflects, it might take a couple days, you know, to get all the offers and complete the transaction and get it ratified, but it's pretty much saying over the half the houses are going to be gone by the end of the weekend. And it also, you know, if we flip to average, so if we look at the average is 28. Now, keep in mind, it's just like pricing. You could have a house that's on the market 300 days, it's throwing off the average. And I wish that there was another statistic on here that I always talk about with ABC. It's like it's days on market from the final list price. You know, if a house is on the market 200 days, they change the price and it sells in 5 days after they change the price. That's all I care about. So I think this median reflects better the market conditions, that if you're not selling within a week or two, the market is obviously telling you you're overpriced. I mean, this is the best market I've ever participated in. To know what the market value is, just throw it on the market. You know, the market is going to tell you if you're high or low, you know, and it will adjust accordingly. You know, if you're too low on the price, you're going to get multiple offers and get over full price. And that is the market kind of giving instant feedback on your price. If you're too high on the price, you're potentially not getting any offers. So that's the market telling you pretty quickly, hey, you need to lower your price. So, I mean, isn't it amazing that 60 days seems like an eternity for a house to be listed right now? And it's because everybody's used to a 3 being the median days on the market at this point. And you know, and keep in mind, when you go to spring, summer, it usually goes down. But I mean, if we go back in time, we were, look at that in 2008, 9, 10, 11, even up to 12, the median days in the market was 2 to 3 months. So this was kind of the norm in this range here. And then we obviously started to drop, and then we created this new norm, 2015 to 2020, beginning of 20, we were in the 20 to 30-day range. So really kind of within a month, you were kind of going under contract. If it took longer than that, you were probably overpriced. Now that month-long period has turned into a couple of days, 2 to 3 days. So it's important to, be prepared as a seller for showings. I mean, I just listed one this morning in Hamlin Plantation, tenant occupied. So you know where the tenants are for the weekend? They rented a place on the beach because, they knew they were going to get crushed with showings. They're like, you know what, we're just going to be out of the house. So it's important if you have a tenant occupied house to have your tenants on board with like, hey, I'm only going to bother you for a couple of days, but you're really going to be bothered for a couple of days. So maybe can you like go on vacation, go out of town for a couple of days, just block off some major time. And it's better to have that conversation up front, because obviously a tenant occupied house, that could become a pretty quick nightmare if they don't realize that they're going to get inundated with showings. So, here, this days on market, I mean, we're down to 3, and it can only go down to 1, I think. So, I mean, we're about as low as it's ever going to go. Here's months of supply. So for the month of April, we were 0.7 months, which if we go back to last April, we were at 3.5. So 3.5 was pretty good. It doesn't compare to 7. I mean, we're 5 times, this is the best way to look at it, 3.5 to 0.7. We're 5 times faster than a year ago. And yes, year ago closings, that was kind of during the shutdown, but you can see where we were at for many years. Even 15, we're at 5.3. I didn't think the market was bad in 2015. But we were at 5.3. We're a fraction of that now. So we're a magnitude faster now than we were in 2015. And I didn't feel like that was a bad market. And even if you go pre-recession, the lowest we ever got was about 3. So, I mean, we are 4 times faster than the fastest point pre-recession. So I know some of you on this call were in the business, with me back then. But we are 4 times faster than pre-recession. The market was crazy back here, and I mean it's unbelievable right now to have 0.7 months of inventory. So homes for sale. So if we go flip to homes for sale, and I'm gonna just go to 3 years for a moment. So we're 72.8% lower than a year ago. So essentially, if we had 4 listings a year ago, we basically have 1 now. So, we're down to 1490. I think I was looking this morning, we're in the the low 1400s right now. We kind of hit a new low this week, but the new lows seem to be not that much lower than the past week. We'll see what happens going forward, but I think we're trying to form a bottom, and we have been for a couple months now, trying to find a bottom on the inventory, but it seems like as soon as new listings come on the market, they're getting absorbed, and until that slows down, we can't build back up this inventory. Now, I mean, you just go back to 2019, look where we were. We had 6,000 homes for sale. Was this a bad market back then? No. That market was a more stable, even playing field market between buyers and sellers. But when we had 6,000 listings, we're at, 1,400 and change right now. So, I mean, we need 4 times the listings to get back to a normal, market where a buyer can have their time to look at a house, evaluate their decision, come back and look at it a second time, and make an offer, negotiate the offer, get repairs done, have an appraisal done. We need to get back to 5,000 to 6,000 listings for that type of normal market to return when we're selling as many as we are in a month. So we are in this, this place for a while now. Closed sales. So when we look at the closed sales, so look at, so this is going back 3 years. Let me go back to homes for sale just for a second. Sorry. If we go back in time, so pre-recession, our low was 4,100, roughly almost getting to 4,000. So let's say we had 4,000 listings pre-recession. How many more people are living in Charleston 16 years later? And we have a fraction of that for sale. So we have more people living here with higher demand and basically a fraction of what we had even pre-recession. But look what happened after the recession. You know, we were almost hitting 12,000 listings for sale. So we had 12,000 listings for sale in 2007, 2008, and now we have 1,400. So just to show you a difference in the market. I mean, I can tell you what, I have a lot of signs sitting in my garage going unused because I was carrying a lot of listings back here, and you don't have many listings today. If they do, the signs are not sitting in the ground for long. They're certainly not rotting out, that's for sure. So closed sales, I'll go back to 3 years. So closed sales, so we closed 2,148 in April, 2,183 in March. Now keep in mind, if it closed and an agent didn't put it in MLS and it was just an off-market sale, we have more sales than this happening, but this is what's showing in MLS. Now, last July, we had 2,435, so that was an all-time record, but you can kind of see we're in September, October, November, or August, September, October. You know, December, we had it over 2,000. March, we had over 2,000. April, we had over 2,000. So we actually had less closings in April than March, and I think where we're running into problems is we're running out of listings to sell. So our buyer demand is there, but if you don't have enough listings to sell, this number, I just don't see how it can go much higher. You know, we're just running out of sellers. I mean, to have a transaction, you've got to have a seller. So, I mean, we're sitting around 2,100. You know, it'll vary a little bit from there, but I don't think we're going to go much higher than where we're at right now. And if you go back in time, if we look at closed sales, go back in time, I mean, these numbers are huge compared to historical. And I want to put in perspective, 2,148 closed last month. In 2009, we had 435 closed in January. So, you know, this is obviously the low period, and now we're in this really high period, like consistently hitting 2,000 or higher. Let's go back to 3 years. So new listings. So when I look at the new listings, we had almost hit 2,500 in April. Now, we go back and look at last April, you see this drop from March and April. Well, we were a complete shutdown mode, right? So you can't really look at this 38% and take it with much credibility because, you know, in March we were 2,290, in May we were 2,418. This was this artificial dip with the shutdown. So if we kind of go between these two numbers, we are right about where we're at today. You know, if April was a normal month, it probably would have been very similar to this number. So, and you have this seasonal effect where there's less listings in November, December. So we don't look that different. And if I go back further in time, so it doesn't look that different than historical over the past 5 or 6 years. You know, so we are still on that same pace of what listings are hitting the market, but the pending sales, look at the pending sales, we're hitting last, and let me zoom in a little bit. So last July, that was the highest month prior to the last couple months. So we had 2,356 pending in July. We had 2,443 last month, and we're at 2,522 today. So I also want to put in this perspective, there's a lot of deals off the market that aren't in MLS yet that are under contract. So this 2,522 number is also artificially low. And you know, we're 67% higher than last April, but keep in mind, last April was the shutdown. So, you know, look at the jump from April to May. So this is the biggest percentage jump we're going to see here in contracts. It'll start to slow down and normalize in May once we start that 12-month cycle again. Now, if we go back in time on the pending sales, you can see we're hitting highs there and, you know, compared to historically where we were. Dollar volume. So on dollar volume, let me zoom in. So we hit over $1 billion in sales last month. We hit over $1 billion barely over $1 billion in March, and then we hit $1 billion last July. So that's 3 months we've hit over $1 billion in sales. And obviously we had the seasonal drop here in January and February, but it jumped right back up in March and April. And it was not quite $1 billion, but it was over $900 million for several months in here. So, we still saw the seasonal trend. And, I don't think, I think this seasonal drop is still going to exist this year. I still think, we're going to sell a lot of houses, but I think you're still going to see that seasonal traditional slowdown. But we're over $1 billion here again. And if you look back in time, and again, for agents, look in January of 2009, we did $112 million in sales, and we're over $1 billion now. So we're almost 10 times what we were doing in January 2009. So, and even look at the peak markets pre-recession, we were, $500 million. So we're double the volume we were back here. And it's, yes, part of it's transaction count, but part of it is higher prices. Those prices are driving that dollar volume. So, $1 billion in sales, I think, we'll probably hit it a few more times this year, potentially, or very close to it. But again, I think this at some point maxes out as well, because you can't create transactions without having a seller. And I think we're just, until we get some more inventory hitting the market, we're going to be struggling to push these numbers much higher. And I mean, look, compared to last April, it almost doubled. But again, last April was shutdown mode. So, yes, this is exciting, but this pace is just not going to keep up. It's exciting if you're a seller. It's not very exciting if you're a buyer. But shows depending, we've been sitting about 15 or so, which is higher than we were. But keep in mind, that's because you have this instant, pent-up demand that everybody's scheduling showings within the first 2 to 3 days to try to get there. Showings per listing, again, 13. So we're higher than we were, but it's that instant demand again happening. So, you can see from a standpoint of where the market is, where it's headed. We're obviously still in that spring rush. I mean, traditionally pre-COVID period, I always had May 22nd as that date that was the peak number of pending contracts, if that makes sense. So, just from my number analysis, the end of May is traditionally your peak seasonal period for having properties under contract. So after that date, the number of contracts starts to slow down. Before that date, it's building up. And traditionally, it's a very quick build up and a very slow tail off. So it doesn't mean all of a sudden June, July, there's no contracts happening. It just slows down traditionally. This year in 2020, I mean, who knows what the seasonality looks like, but that still is in play. And, with Charleston County being only school for the kids being only out for 8 weeks, from the last day of school is June 18th, the first day of school is August 18th. So how many people are going to try to cram a move in that window? Well, June 18th is not that far away. So, contracts are being written today. A lot of them will be closing in that summer period where the kids are not in school. So, I mean, that is something to keep in mind, that we're going into that period of time. Now, I talked to somebody who was moving here from Virginia the other day. The schools are still shut down around DC. So what's very interesting is that for those potential buyers in Charleston, if they're like, wait, the Charleston school district is open and I can send my kids to school and I've always wanted to do this and I want to move down there, they're going to try to get in before school starts, right? They're pushing that. So, I still think Charleston is going to see that flow of buyers coming into town, partially because a lot of these areas, school is still shut down, and I don't know if they have actually called, a decision on what they're doing in, the next school year. But, you can only go so long with, not having your kids in school. So I think that's going to spur on some activity to bring people here to get started so that they can send their kids to school. So all that being said, is that, watch the interest rates. Where is that headed, and what is that dynamic having an effect on the buyer's purchasing ability? As rates over the long term tend to go up, your buyer demand might start to slow down, and we would see that on the pending sale side. But at the same time, if that buyer demand slows down, I think we run the risk with higher rates of actually choking off the homes for sale even more. Meaning, some of these people selling, they're taking advantage of the low rates and moving locally or even out of town. But if rates jump up fairly significantly, people are going to want to stay with their house just as much as because of their rate as because of their house. In the end, people are buying off of payments. And that's something to watch for, is that the higher interest rate might slow down demand, but it also might slow down our supply. So this is not an environment that we've been in the past 20 years. The past 20 years, for the most part, has been a declining interest rate environment with spikes every now and then and a little, roller coaster movement. But for the most part, it's been a downward trend. The interesting part will be when that trend starts up, what dynamic that's going to have on all of these numbers in here. So again, all that is in play. And I mean, anybody, you read articles and they say, oh, we're in this real estate bubble. And maybe that's because people, don't forget what happened back here. But this is such a different market. And I know we've spoken about this before, but I want to reiterate how much of a different market it was than pre-recession. Pre-recession, people had marginal credit scores. They were buying strictly as an investment properties. They weren't putting much money down. They didn't have really documented income with the IRS. The loans were very loose. Now, you have these lenders, and I don't want it to change. The lenders are very tough still. You still have to show and document everything and show that you're qualified. But the people writing offers, I mean, they have the cash, they have the down payment, they have job security, they have savings. For the most part, it is a very healthy market. And a big difference is most of them are primary residence buyers. They're not investors for the most part, just looking to flip money. Yes, there's still a mix of investors out there, but not what we were experiencing back in here. Most of these people winning contracts, a lot of them are primary residence buyers, and they're financially secure, and they're not going to default on their house or lose their house. But also, anybody who wasn't making payments back in here, they had negative equity on their house. I'd say it'd be hard pressed for me to show me many houses in Charleston right now that are negative equity, meaning they've borrowed more than what the house is worth. I bet those are very hard to find and few and far between. Part of it is because the lending standards tightened up so much that you couldn't, borrow too much on it, but also the run up in value. You can't have an 18.4%. I mean, think about it. If somebody had a $500,000 house a year ago, now it's $600,000. So they've got an extra $100,000 in equity in their home. So it's very unlikely somebody's just going to walk away from a lot of equity. And if they bought it a year ago for $500,000, they probably put $100,000 down, so they've got a couple $100,000 in equity. They're not just going to stop making payments and walk away from their house. They're going to find a way to continue to make the payments. And if something happens and they can't, well, just stick a sign in your yard and sell it. Take your equity out of it. It's not like what was happening back here, where there was no point in moving because you were negative equity and the bank wasn't kicking you out of the house, so you just hung on as long as you could, and then those all turned into foreclosures and short sales, which drove the market in here. But I just don't see that, window happening at the moment because of the different dynamics. So I mean, that's most of what I wanted to cover today. I'm more than open to, discussion. If anybody has any questions, if they want to add anything, everybody's welcome to contribute. I'm trying to see if there's anything in the chat box, but I don't see anything at the moment. Keep in mind, your conversations, are based off these numbers and giving confidence to sellers and giving confidence to buyers. There's not, I don't see where the red flags are for buyers right now to keep moving forward and making a purchase, because everybody needs a house to live in, right? and they're either renting or they're buying. And the last time I looked, I think we're about 65.8% home ownership in the U.S. And that's a fairly, normal number that is not out of line with historical numbers. And, it doesn't vary that much over time. I think we're a little bit on the higher end, but what are rent rates doing right now? If I could pull up the rental chart on this, what would it look like? It would look very similar, right? I bet rents are up 18% over the last year. So, if your choice is a $4,000 a month rental or a $3,000 a month house payment, well, I'm guessing to say a $3,000 a month fixed house payment over the long term is probably a better place to be. So, from that aspect, you just have to keep in mind, if you can get a fixed rate at today's rate, you don't have to worry about inflation when it comes to your house, right? It's like, you have to worry about it if you're renting and every year the rental rates are going up. That's something you have to be concerned with. But if you're a home owner and you have a fixed rate for 30 years, you know what your payment's going to be. So even if inflation kicks in, you're very secure from what your house payment is. And traditionally, your house payment is going to be your biggest payment. And I think part of what we're experiencing, man, I've heard some crazy stories on, supply prices for houses on lumber and, plywood and windows and everything else. And I haven't seen this in person, but I heard there's a development up in Somerville that they've got some houses wrapped because they don't have the windows. The inside is complete. The outside is complete except for no windows and no siding, because you can't do the siding until you get the windows. So you've got crazy supply situations where, you're waiting to close on a house because you can't make windows fast enough. And again, we're experiencing this all over. If you look at rental cars. So I'm going to see my parents for the first time in 20 months here this month. So I'm excited to do that until I booked my plane reservation, which was fine. But I also looked at a rental car for 3 days in Houston, and it was more than my plane ticket. It was like $350 for the cheapest car I could find. And it just shows our economy is having this supply problem. There's no rental cars. So the rental car rates are, I probably used to spend $75, $80 to do that. And now it's $350. So I'm going to Uber to my parents' house and use their car. But anyway, from that aspect, look at every aspect of society and look at where the supply chain problems are happening. And that's a perfect example. The rental car companies unloaded all their cars during the pandemic thinking we're not going to need these. And now that demand is returning, they don't have any. The chip problems that car manufacturers are having, Ford slowing down their production because they can't get enough supplies of the computer chips. So we're creating the situation where prices are being driven by supply and demand, not just in the housing market, but in other aspects of life. If you read, they're talking about a gas shortage this summer because of everybody taking travel vacations and trips. And it's not because there's limited gas. It's because there's limited truck drivers to drive the tanker trucks to the gas stations. So this is an employment issue where they don't have enough bodies to, truck drivers to drive the trucks. So it's if you read about like what's happening in our economy, we are trying to find, a balance in many aspects of life in this new world that we live in, from a business aspect. So I see a comment from Sean. Does anyone remarkable multiple offer situations share? It helps with market knowledge. I know Sean and I were talking earlier. I had 26 offers with a buyer on a house that I was over full price cash with them. I think we were probably still off by 10%. I have no idea how much we lost it by. But most, again, like what I'm saying is your buyers have to be prepared, and sometimes they have to lose one to learn. But I really think probably getting close to 2/3 of the houses are multiple offers. So your buyer has to understand it's like you can't mess around. You have to go look at it, and you have to make your best offer up front, and you still might not get it. So it's just having an understanding and expectation for those buyers of where they stand. So, we learn something new every week of different situations. But with this market and these numbers, I think we're here for a little bit. So you kind of have to keep up that due diligence with your buyers, and then get your sellers ready to, and again, just because you get 10 offers, sometimes you're sort of like, oh, we priced it too low. It's like, well, the market is going to correct one way or another. If you're a little low on the list price, you're going to get over full price. If you're too high, then the market's going to tell you very quickly, and you need to change your price accordingly. So, well, I hope everybody has a wonderful Mother's Day weekend. Looks like it's going to be beautiful out there, whether you're traveling somewhere or staying put. But we'll do this again in a month, and I think the trend's still going to be up. But watch that the trend year over year is going to slow down once we start catching up with the post-COVID 2020 numbers. But we're still on this upward trend no matter what. So everybody have a great weekend out there, and we'll see you in the office or online here shortly. Thanks again.